All right. So, how to consistently profit swing trading with options and seasonal patterns. Today, I'm going to be going over one of our strategies, taking a big look at the overall market, what's been going on, taking a look at upcoming seasonal patterns and how we kind of incorporate them in conjunction with our strategies and for help with timing. There's some optimal times to go short, some optimal times to go long, not just for the strategies, but based on market history. So, everything we're doing is for educational purposes only, not giving you any specific trading advice. So, what this is showing you how myself and Becky, she's the co-host and my trading partner, how we've been profiting from the markets using these same strategies for quite a while now. We both started back in 2005 and we're still going. So, and for as far as options go, our approach to trading and managing options really hasn't changed much since 2009. Some of the strategies tweaked here and there, but the actual trade management and the style of trading we do has pretty much been in place since 2009. All right. These are the only sectors we trade. It gives a pretty good diverse range of markets and also option prices. Not everyone can afford to trade everything. If you were, and we only trade in the money options, no way out of the money options. We're not doing spread trading and we're not selling premium. This is buying calls and puts, and we always buy the first in the money option. You want to go deeper in the money, it's up to you, but usually the first in the money option are right at the money. So since it's all different pricing for options, if you're going to be trading DIA or SPY or QQQ, you need a bigger size account because those options cost usually between $1,000 and $2,000 per contract in that range. So they may give you great results, but they also cost more. And then you have options like EFA, EWG, they cost a lot less. So there's something for everyone that can, as far as cost wise and diversity wise, so, and all different prices and markets. Some people really like the trading oil. Like trading oil, you can trade USO, you can trade XOP. Okay, so there's different things for everyone because we all have certain things we like to trade. Personally, I like trading the main indices, Dow, Nasdaq, and S&P. Okay, someone asked a question. Will these strategies work during the Trump every week volatility? The technical strategies have nothing to do with news. Basically, I couldn't care less why the market is moving. Couldn't care less. Um, and if you are a day trader, maybe you care about what's happening today or what's happening a minute ago. But we don't care. Markets go up and down year after year, day after day. There's always something in the news moving markets. And because the only reason we even think about like tariffs is because the news media happens to be talking about it this particular week. Next week, they'll be talking about something else. And we won't even be thinking about that. So it's whatever. So we wouldn't be even thinking about that if news media didn't focus on that for that week or that day. Because literally they move on different things each week, each month. And whatever's in the news that week is so don't care about news, don't care about politics, don't care about what's happening in any country, don't care about wars, don't care about nothing. Pure technical, pure technical. And we're going to take a look at the charts. And so I always start out with this setup, this meetup with going over the big picture of the markets. And when you take away the day-to-day noise of all the people talking, and it's a picture perfect pullback that I've been talking about at our last meetup when I said we need to drop about 10 more percent. It's picture perfect, except the people in the news create all of this worry, all this fear. The market's going to go to zero. It's going to filter all that out. It's entertaining to listen to, has nothing to do with our trading. So let's take a look at the big markets first, then we'll come back to the handout. Because when you look at the big markets in a bigger picture, it's so easy, and you go like, it can't be that simple, but it really is. I'm gonna change the share because been telling people to at the last meetup, we need to drop 10 more percent. That's going to be the perfect buying opportunity. Okay, so this is the S&P. This is a monthly chart of the S&P. So this line here is an 8-period moving average. This line here is a 40-period moving average. Every candle is 1 month. 1 month. When we look at the big picture, it's a lot simpler without all the day-to-day noise. Okay. This is going back to 1998. And most of the time, we will ride the 8-period moving average and keep pulling back to it, keep pulling back to it, keep pulling back to it. And then we'll break down to this was the 2000 market crash. When we get 2 consecutive closes below the 40, we're looking for a deeper move down, and that's what we got. And then on the way down, it rides the 8, pulls back to 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 the 8. Okay, and eventually we go back above the 40. Every maybe 18 to 24 months, the market pulls back to this 40. We've been in an uptrend since this whole period here, and every pullback to the 8 is a major buying opportunity for swing traders. So when I'm timing my daily chart strategies, we may get a buy signal up here, but I'll wait for a pullback as it gets close to the here, assuming the target wasn't already hit. And I look for what buy signals do I have, are still valid that I haven't taken yet. I might get buy signals up here. Upon this pullback, I look for what buy signals are still valid that I haven't taken yet, because we get the biggest moves after the pullback to the 8. All right, and then we got a breakdown finally. And this is the 2008 market crash. 2 consecutive closes below the 40, and the market goes lower. And then we came back above the 40 in 2009 and 2010. And we've been riding this uptrending 40 for the last 15 years. Okay. Periodically, we pull back to the 40 and go. For the long-term investors, every pullback to the uptrending 40 is a buying opportunity. Anywhere close to the 40 is a buying opportunity for the long-term investors. And for the short-term swing traders like we are, once again, the same way we look for buying opportunities on pullback to the monthly 8, we look for buying opportunities for pullbacks to the monthly 40. Okay. Going up, and this uptrend has gone on since 2009. Every pullback to the 8 is a buying opportunity, short-term buying opportunity for the swing traders. And then we'll have a pullback to the 40, a deeper pullback. During this pullback, there's a 1-month pullback. You're going to hear in the news, the sky's falling. Everything's going all to hell. Everything is, because the news media report on what's happening that day. They don't report if it goes up the next day. They don't even talk about that. But they report, and it makes it sound like the sky is falling, and it's not. The market has to pull back. Market has to pull back. It goes up, it pulls back. It's just that it pulls back faster and harder than it goes up. It might take 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 months to go up this high, but it took 1 month to come down this much. So, and that's just normal trading. It takes a long time to go up, but it takes a very short amount of time to come down. And it makes the news. And they blow it up and make it look like it's worse than it really is. But for the long-term investor people, any buying opportunity is right around the uptrending 40. Anywhere around uptrending 40, buying opportunity. Here we are, pullback. Anywhere around the 40, long-term investors, buying opportunity. When you see the market getting crushed, don't get afraid. Be like, yay, the market's getting crushed, because opportunities are coming up. You got to be patient. And guess what? During these time of pullbacks, our short trades are making us money, because we have short trades set up all through this pullback on the daily charts. So we're not just sitting there, oh, the sky's falling. No, we're making money on the way down and then looking for the time to make money on the way up. Okay. And the more patient you are, once again, every pullback to the eights, a buying out, every pullback to each one is 1 month of time. But the more patient you are, every pullback. This was COVID 2020. This pullback lasted only 3 weeks. This is actually 3 weeks of time. And when everyone thinking, wow, the market's going to keep going down, 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 down. No, they just make it sound like that on the news. Okay, that's just the way they make it sound. The market's not going to go down, not going to zero. And this rally, this drop literally only lasted 3 weeks and then the biggest rally ever. Okay, periodic pullbacks to the eight. This was 2022. We got to pull back to the 40 again. Buying opportunity. All anywhere around the 40 buying opportunity. 88888 pullback. Here we are. At our last meetup, this was a red candle right at about here. That's when I told people it needs to drop about 10 more percent, about 10 more percent, and then it'll give you our picture perfect buying opportunity for the long-term investors. I don't care about tariffs or anything else. It's driving markets for a while. The market needs a reason to pull back. Tariffs gave it a reason to pull back. It doesn't say tariffs are going to make the market go to zero. Okay, it just gave markets a reason to pull back. Things in the news happen every couple of months to give the market reason to rally, and it gives markets a reason to pull back. It was a reason to pull back. And let's get real. It's a political thing, it's a business thing, and it's a short-term uncertainty thing. Whenever the market's uncertain, it pulls back. The long-term people like, yay, right back to support levels. Like I said, I told people right here at our last meetup, look for about another 10% drop, and it will tie in with a seasonal pattern also, which I'll go over in a minute. So everything that's been happening is literally exactly the way it shows up on seasonal patterns for this time of year, as far as when to go down or when markets go up. Markets have been in this massive uptrend since 2009, except for the periodic pullbacks to major support, and that periodic pullback happened in April. Pulled back to support, and our uptrend is continuing and strong. Nothing's changed. It pulled back for a month, for several weeks, and that's it. And we just continuing on. So, like I said, nothing's changed from our massive uptrend. It was news driven for a little while with this pullback, but as when we are technical, we don't care about one news thing that we focus on out of the hundreds of news things going on every month. We just tend to look at one because that's what they're talking about in the news. As soon as they stop talking about that in the news, they'll talk about something else. So disregard that stuff, keep it objective, and you might think about it if you're a day trader, that might have day-to-day impact, but since we're not day traders, it's non-factor. It's just more scary than anything else. I'm going to put in the chat window again the link for the handouts if you want to go to the website and download them. Okay, so along the way, if you have any questions, unmute, ask the question, or don't raise your hand. Probably won't see it. Just unmute, ask the question, or type in the chat window, and I'll eventually see it. But it's been fun trading. My mother used to actually call me up whenever she saw the market dropping massively and it was in the news. She literally call me up and say, you must be having a really good day or a good week. I'm like, why are you saying that? Because we saw the market just getting, she learned along the way that that is the picture of what I look for opportunity. Oh, great, the market's pulling back. Let me take a look at what trades I'm not in because I might find a good opportunity to get into this trade at a much better than expected price. So that's what I look for on market pullbacks. So what's the significance of 40 EMA? Okay, what's the significance of this? The 40 I learned from myself and Becky learned from Oliver Velez. It could be a 50, it works for you also, but a 40 learned from Oliver Velez. He had that on all of his charts, and it was a foundation of what he did. And after learning from him and looking at our charts and what we do, we found it also would work extremely well on our charts. It's a good indication of trend. It's a line in the sand also, for bullish and bearish. You find it on just about every single one of our charts for our options and future strategies. So the 40 is used heavily. I actually originally learned this type monthly strategy, long-term investor strategy, using a 50 period moving average. So I actually learned an in long-term investment strategy using a 50. And the only thing on the chart was a 50. The 8 period, that was one of my foundation things learned from John Carter, Hubert Centers. It was the 8 and 21 moving average, and we would just swing trade off the 8, swing trade off the 8. This was more day trading times when we just pull back to the 8 buy, pull back to the 8 buy, pull back to the 8 buy. So that was a swing trading thing, but it works in all different time frames, whether it's daily time frame, weekly time frame, monthly time frame. Also, the 8 period moving averages were heavily used with Jake Bernstein, if you remember the 8 open close. So that 8 period value has transcended through different people who we've learned from, and it works for us really, really well. So 8 and 40 have just been a foundation on our charts. Let's see. How far along do you set your expiration dates? I'll be going over that in a little bit for expiration dates. All right. And everything, and there are no looks like, feels like stuff. It's like everything is very definitive time uh for option expiration. Okay, I'm going to switch back to the handout now. Let's see. All right. Okay, back to the handouts. Like I said, this is the only list we trade. This gives us these ETFs gives us enough variety and also enough ETFs that have option volume and open interest. There are 1,000 different ETFs, but many of them don't have enough option volume and open interest to be realistically tradable. This list does. Whether you're a big trader, big dollar trader, or a small dollar trader, there's something here for you to trade. If you're someone who's trading hundreds of contracts, then there'll be a smaller subset of this list that you can trade effectively. If you're trading 2, 3, 4 contracts, and everything here is tradable, not a problem. So there's something for everyone in between, from the small trader to the big trader. If they have a huge monster account or a small $5,000 account, there's something here for you to trade. All right, so I'm going to go down. Seasonal pattern. We look at different seasonal patterns. This is also from Jake Bernstein's seasonaltrader.com. So feel free to go to Seasonal Trader and access the current seasonal charts. They update it every year. They don't change that much. So every couple of years I'll go in and update it. But Seasonal Trader. Do you use the leverage ETF? Absolutely not, because they're not linear. They do not produce linear charts. The leverage ETFs are not linear. They don't create charts with the same formula as just open, high, low, and close. And it's different. So the charts do not work with these strategies. They do not work. They're great for day trading, but if you're trying to chart the strategies, they will not be correct. And it's possible you can trade. It'd be challenging. It'd be challenging since we're doing options. It'd be challenging. But you have to take all your trade signals and targets and everything else off the regular standard QQQ rather than the leverage ETF. So you'd have to. There'd be no point in doing it. I've seen people use the leverage ETFs for day trading certain things, but for what we do, not leveraged ETFs. All right, so this is a seasonal pattern where it's more likely than not, this is, and this is kind of what we've been seeing. The market, if we go back to April, we would have seen, I don't have the April part here, but Going into the end of May and the first part of June, the market tends to take a bullish type of move, then chop sideways and down, and then, but generally, um, a bullish type move over the next couple of weeks. All right, more often than not, the market is in a slightly bullish pattern for the next few weeks from the end of May through the beginning of June. Doesn't mean it goes straight up. Um, there's a time, which I'll show later in the year for the October, where there's basically a straight line up for 2 months. That's the best pattern of the year. That's what we trade every year, October, November timeframe. It literally goes from here up. That's October. So that's our best pattern. But for the next couple of weeks, well, let's say I got a sell signal tomorrow on the major markets, I'm not taking it. Okay. I might miss the trade, but I'm not taking it. If I got a buy signal tomorrow on the major markets, guess what we have? Gotten buy signals. Then the bias is to the upside seasonally. So right now we're getting a lot of long trades valid. And more likely than not, a lot of them are going to be good winning trades because it's also tied in seasonally. And it happens to be tied in with that big picture chart you saw, the monthly, super bullish pattern. And guess what? Even the news, everything people were looking at, what about China? What about this? They already made a deal. That's all short-term stuff and creates some volatility. And everything is right now is bullish. Even the news is bullish. Even the tariff stuff is bullish. So right now, the longs are in play on our strategies and our charts. Everything is, and we'll go over that a little bit in a second or two. Everything right now is to the upside for the next couple of weeks. If I get a sell signal here, I'm not taking it at that point. I might take it later on if it's still in play, but I'm going to hold. If I got a sell signal here and it hasn't dropped before then, and I get a sell signal up here in the middle of June, or I got a sell signal here, but I haven't taken it yet, I might take that same sell signal up here as opposed to taking it back here. But I'm going to pass on sell signals until for the time being because seasonally this period of time is bullish. So I'm passing on all new sell signals. I might miss some trades. If I miss it, so be it. There's going to be 100, 200, 300 more trades to take. It's not a big deal if you miss a trade. But the edge right now is to the upside for the next few weeks. So that's all I care about is long trades for the next few weeks because it matches the seasonal pattern. So right now we got a bunch of buys on a lot of stuff, daily charts and weekly charts. And for those of you who are already my coaching clients, you got the email this weekend with even more long trades valid. And there's several already in play. And the ones that were in play from weeks ago, they're already hitting targets. After the big drop, we got our sell signals, and then we get the long side now. We got our buy signals. So don't hesitate. This is the time. If you're going to trade long, then the seasonal is helping you. This is everything. The news is helping you. The seasonal patterns are helping you. Everything is saying go long. And at least for the next couple of weeks, this is where I'm going to focus my energy as far as my trading with ETFs and options go. Right? So this is a strategy some of you have seen in the past, and we'll go over real quick on the chart on a daily chart. We're going to show you one. It's a Donchian crossover buy. This is just a general how we set up a trading plan. There's real bare bones. It's set up trigger trade management. This is terminology once again from Jake Bernstein. He's someone who myself and Becky met back in 2009 when he moved to California. At that point in time, Jake opened up his whole trading world to us. Um, Stuff he was charging other people for, he made free to the people within our group. Stuff he charged $1,000 for was free to us. And that eventually came to an end for certain reasons. He had to end that. But we learned a lot from him, including how to maximize profits on trades and how to approach trading and get more bang for our buck. Okay. So it was a good experience working with Jake. So I'm going to switch over to the charts. And then we'll come back there. All right. So what you're looking at right now is a daily chart of the Dow. And Dow as in DIA. Okay. So let's go with QQQ or SPY since that's on the daily there. So on the handout. QQQ. NASDAQ. All right. On the downtrend crossover buy, on the chart, this orange line is the mean line from a downtrend channel. The downtrend channel is 3 lines. This is the mean line, the middle line from I'm not showing the other 2 lines because we're not using them. So since I'm not using them, I don't need 2 extra lines on the chart for no good reason, so they're transparent. The blue line is a 40-period moving average. Okay, this dotted line is an upper Bollinger Band. I'm not showing a lower Bollinger Band or middle because we're not using them. So don't need 2 more lines on the chart that we don't use. All right. So what are we looking for? Setup trigger trade management. Once again, Jake Bernstein terminology. The setup is looking for the orange line crossing over the blue line. That's it. I'm looking for the orange mean line to cross over the 40-period moving average. So when we do our review each day, hey, did orange line cross the blue line? Nope. Next. Orange line cross the blue line? Nope. Next. It takes that long to do a review. If there's no setup, it's very visual. If there's no setup, there's nothing to spend time on. Orange line cross the blue line? Nope. Orange line, hey, wait a second. The orange line crossed the blue line. If you're not really sure, you look at the data box on the side. This is NinjaTrader. Is the orange mean line 521.99? Is that greater than the blue line, SMA? Yes. 521.99 is greater than 521.25. So we have our bullish crossover. Okay. We know that based on 23 to 25 years worth of data, basically every valid trade since the QQQ has existed, that we're going to have 85 to 90% winning trades if we buy call options and following this valid signal. Okay. But we need to know how big a target to do. We don't just manufacture, well, it's going to move forever up. No, this is not like that. You have to have the statistics to know what's the probability of the market moving this much before in your direction before this option expires worthless. Okay. And that's not enough just by itself, because a part of what we do is from experience. Because just buying a call and saying you're going to hold it till it hits the target, you don't know if it's going to be worth anything because there's time decay and that type of thing. So, but this type of trading wasn't as effective on stocks. However, it's been very effective on the ETFs because of the much lower implied volatility. We don't have that volatility crush where you see with options on stocks. We don't see that really on the ETFs. So we can buy call options on the ETFs and look for a certain magnitude of movement with a relatively high probability that it's going to be actually profitable, meaning worth more than you paid for it. So our target, take a look at this is our valid trade date. We look at it as it closed below the Bollinger Band. Yes, if it was past the Bollinger Band, we don't take it because it's already very extended. It's going to pull back. How many days was this in the bullish cross? If it was chopping back and forth all the time, we don't take those trades because the market's just going sideways. We have a nice clean crossover. Take a look at the data box. The ATR is $9.12. It's moving 9.12 points. Is a 5 period ATR, meaning every 5 days on average, the NASDAQ is moving 9.12 points. That's going to be our profit objective, our profit target. We're looking for that big a movement, 9 point movement upward. So, and that is going to be based upon calculated from the open price the next day. So someone pull out a calculator. I want to ask you to give me a number. What is 9.12 added to the open the next day, 521.82? I'm going to type it in. Open is 521.82. Open 521.8.82. Open 521. All right. In the data box, 521.82. And if you add this ATR 9.12 to that value, what is it? What price is that? 9.12 added to 521.82. 921 plus, okay, thank you. 530.94. That's our first profit objective. Okay. That is our analysis of market volatility. Based up, the ATR tells us how much this market is moving. We're not doing analysis on options. We just did our volatility analysis on the underlying ETF. That was it. No risk graph, none of that stuff, no complex count, none of that stuff. What we're doing with options is using options to capitalize on the opportunity. Okay. And there's certain rules we have for the option that we go over during one-on-one coaching. There's certain rules for pricing, so on and so forth. But that's the opportunity. That's how big it is. So if the target is 530.94, the very next day, you would be entering the trade at or below the open price. That day, the high was 527.01. This day, the high was 529.81. And this day, the high was 532. So the target was hit this day, somewhere near the open. So somewhere it gapped up, opened, and the target was hit. Okay. So this trade took 2 point something days for the first target to get hit. Now, we'd be buying the first in the money option. If you are getting in the very next day after the trade is valid, it opened at 521.82, so you'd be buying the 521 call option. The first in the money option, that'd be 521, assuming a strike every point. 521 call option, whatever that costs. It was expensive, but you got the same concept, whether it's a $1,000 option or $200 option, same concept, first strike in the money. And when you buy that option, now there's going to be usually I'm going to go to the next, I'm going to go to let's see, hang on a second, I'm going to take a look at what I put on the handout. Okay. Usually an option has 1 to 2 months worth of life. Okay. And that is determined by the trading plan and the statistics. Anything you see us publish as far as option win-loss is going to be based upon at least 2 months of time for the option. at least, and that is expiration cycle. And I call it expiration cycle from the Monday after expiration Friday until the following month's expiration Friday. We only deal with one expiration. The third Friday of the month is the only expiration we care about. That's it. No other expiration. That's the one that's been around from forever, the third Friday. The other ones are have been created over the last 10 to 15 to 20 years. So it's you'll hear us say one cycle out or two cycles out. It has to be one complete cycle or two complete cycles. A cycle starts the Monday after expiration Friday and ends the following month expiration Friday. That's one full cycle. Okay. And in our trading plans, we'll give you stats for one expiration cycle and stats for two. If you go one, then you accept there'll always be a higher risk of expiring worthless before the target's reached. If you go two, you have a better probability of the target being reached before expiration, but it's a higher upfront cost. You don't get something for nothing. Okay. So they're trade-offs, and I'll show you how to make more money on some of these trades also. So if this is 2-4, you'd be getting a April either March option would be one expiration Friday or one expiration cycle, and April would be two expiration cycles. If this is valid on February 4th, then March expiration, the third Friday would be one cycle, and April expiration would be two cycles. Okay. And that's based on what you choose is based on the stats in the trading plan. The win-loss percentage and then other factors come into play like how much money's in your account, what can you afford? Can you afford to go two cycles out because it will cost more than one? Some people would rather have a higher risk and go one cycle because it's cheaper, because that's what they can afford. So everything's trade-offs based on your personal reality and personality, and a few other factors in there too, and patience. Okay, so that's the trade. It is that simple. Okay, this is how we trade. I'm going to go back to the handout real quick, and then we'll come back to the charts. Something I want to show you there. But that's the strategy for the Donchian cross. We trade, I think, 6 to 8 strategies as a group together to trade up, down. So we get in market tops, we get in a market, we short market tops, we buy market bottoms. It ain't that hard to find market tops and bottoms. It's just people don't tell you. Unless I believe in showing you how to do it and do it in coaching so you can know how to do it yourself. All right, so I have an example here on the chart. It's the same thing. Orange line crosses the blue line. And that's it. Okay. Use example here of the QQQs. And what we listed was every valid trade going back to the year 2000 for the Donchian crossover buy. This is just for one. We trade 28 symbols. This is for one symbol on one strategy. Okay, the QQQ. One is a win, zero is a loss. These are the stats for one expiration cycle. And these are the stats if you have two expiration cycles worth of time. This is a long strategy. Since 2000, the year 2000, if you're doing to do this with one expiration cycle, you'd have 80% winning trades. With two expiration cycles worth of time, it's 92% winning trades with a 1 ATR target. Okay. Our target for most option trades is 1 ATR, unless you get in at a better price than expected, then that 1 ATR goes out the door and you can have pretty much any target you want. But this is what we do. Anything you see in a spreadsheet in a box, this is what Becky does. She tracks all this stuff, documents everything, and we live and die by the stats. And for coaching clients, we update the stats every 3 months or so and send that out to coaching clients. You can do it yourself if you want, that's fine too. But we update this for ourselves, and it does get shared with coaching clients for up to the first year. If you want to keep it going after a year, then there's an additional cost for that. But for coaching clients for the first year, we give you everything. We also email out the daily trades. So what we found valid every day, we email that to you each evening, so you can compare what you found with what we found. So we do it for 1 full year, so to get you really up to speed. But this is the difference in one expiration cycle worth of time and two expiration cycles worth of time. It's huge. Um, we don't trade anything under 84% wins. If it's under 84% wins, we don't do it. We don't even look at it, don't consider it. I got one guy who's been doing these strategies since 2007, and he will take 83 or 82%. He doesn't really care because he knows it works anyway. So still good. And you might hear this word, the name Steve once in a while. Steve does not go to any presentation. Steve is just was one of my coworkers at Lockheed. I trained him to trade. He traded everything, stocks, options, futures, everything, Forex, shares, you got it. You name it, he's done it. He's gotten really good at it now because since he retired, he only trades options off the weekly charts, and he trades Google. Google is the only stock he trades, and I showed him how to do Google with covered calls, and he just crushed it with covered calls also. But he specializes in the weekly chart strategies because he's retired now, doesn't want to deal with stuff day to day. But he's done so well. Um, he used to come over to my place, and we just come over, you just do it in person. And um, it's funny, back in the day, he used to compensate me with food and golf lessons. So that was how he compensated me for my time, food and golf lessons. So, but you see the difference. Time, you don't give yourself enough time, and your money ceases to exist with options. And it's since you don't know how much you're going to make just buying calls and puts because it's not linear. You don't want to have to struggle to make the money back. So it's a grind trying to make the money back when you take a loss, or more losses than you need to, or extra losses. So I would always prefer to go two expiration cycles because it gives me the best probability of having a winning trade and not having to make back a loss. Okay. Do you go beyond two expiration cycles? There may not be an option available two expiration cycles out. There may not, that option for that month might not exist yet. You'll see one expiration cycle out. You go out 2 cycles. There's literally no options available that because it hasn't been created yet. The next available one is 3 or 4 months out. Then you have to make an educated decision based upon what I'll show you during coaching sessions about option pricing and open interest and that type of thing. And is it worth getting into 3 expiration cycles out because that's the only one available, or 4 cycles out because that's the only one available past one? Those decisions have to be made once in a while. And the answer can be yes if your target's big enough. Yes, if the target's big enough. Because it has to make sense. You have to understand that you just can't just buy a call and expect to make money unless the expected move is big enough to offset time decay and volatility um, effects. So your movement has to be big enough to offset time decay and big enough to offset drops in volatility, especially on the upside. On the downside, volatility helps you, your option pricing. On upside, it does not help you. It works against you on upside. Because as the markets go up, volatility drops out, option prices lowers. As the market goes down, volatility increases, the market option value goes up. So all those factors just have to be aware of. But yes, we do go more than 3 expiration cycles if it makes sense financially and the numbers make sense. All right. So this is what I use as an example. And for 2025, here's what's going on so far this year, just for the Donchian crossover. And this was through Friday. The ones are the ones that trades have already hit the first target. So this is a win or a loss. Okay, this is a loss for 1 expiration cycle. For 2 expiration cycles, this one was a win, and this one's still in progress. Okay. So these are the trades that have been valid in 2025. So you have a list of them in the handouts. just for the Donchian crossover buy strategy. Okay. Remember, we have a group of 6 to 8 strategies we trade together to catch moves up and down. Just for the Donchian cross, this is what's been valid, and these are 84% wins or higher. Only limited the ones we're showing you, the ones 84% or higher. There might be more, but we're not showing you those. But 84% wins or higher. This is what it looks like so far for this strategy this year. All right. And this is one of our overall best strategies to trade also. I know it's one of Becky's favorites, Donchian Cross. It works really, 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 really well. Okay. All right. So I'm going to go back to the chart real quick and just show you a quick way to make more money off trades. Let's find the thing. But there's always the question, how do we maximize profits on certain trades? And it's good to actually see it. We'll look for a good example. Yeah, I think the DIA had a good example. We'll go to DIA. Let's see. And second, I know I had a really good example, but I want a more recent. Okay, it's on Action SPY. Okay, that's why I didn't see it. I want to get crystal clear examples, so it actually makes sense. And that date is, let's take a look at this date right here. All right. This is the one that's picture that's actually in the handout. Are you doing day-to-day review? Did orange line cross the blue line? No. Orange line cross, hey, orange line crossed the blue line. You have a valid trade. Okay. It's going to be 80 over 85 to 90 something percent wins on the upside for one ATR target. ATR is 6.4. Okay. Someone write this down. The open price the next day is 560.47. All right, type it in 560.47. And the ATR on the signal day is 6.4. What's 6.4 added to 560.47? So 560.47 plus 6.4 is what? 560.47 plus, okay, thank you. 566.87. That's our target. Let's see, where's that reached? This high is 559, 563, 563, 566. So on this day, our first target's reached, okay? The open on the day after the trade signal was, let's say it's open, valid there, that's the crossover day. Everything else is valid. The open the next day is 560.47, okay? Well, that means you're buying the 560 strike, SPY strike. But let's say you didn't get in at the open. You got in later that day when it was at 555. So you buy the 555 strike. If you got in at the open, went against you for a while, hit your profit target here, you're looking at a 15 to 20 something percent return on the option. You got in later in the day, 5 points lower than the open. Now you're looking at getting in 5 strikes better. So your option is now 5 strikes deeper in the money. Now you're looking at a 40 to 50 to 60% return at the first target, because your first target doesn't change. It's just that now, since if your target was 640 6.4, but you got in 5 points better than expected. The 6.4 plus 5 is now 11.40. So now your target is $11.40. Get into the open, your target is 640. That's the ATR. Got in 5 points lower, your target is 5 plus 6, 1140. Your option suddenly becomes way more expensive, more profitable at the first target. You may not get in here. I would not get in here unless I might get in down here, wait for another drop. Me personally, I'm getting in after another drop or a bigger drop or something. So I would get in after I see a market declining, and then the trade isn't invalid because it went down. If this trade is meant to be a loss, it's going to be a loss no matter what. But if it's meant to be a win, it's going to be a bigger win, much bigger win. You get into this trade 2, 3 days later because the reality is you have things to do. You have a life. You have work. You got family. You might not be well. You might be traveling. But when you get around to it, you see, oh, there was a bicycle here. I see, what was it, 87% or whatever, but you're not in it because you had other things in your life going on. It's called reality. And you're over here now, and you're like, the entry price was 560, and right now it's at 545, 15 points lower. So 15 added to the original 6 is now a 21-point target. So now you're taking the exact same trade. Some people will get in up here with a 6-point target. Some people might get in down with a 21-point target. I have people who do this stuff like this all the time. The more patient you are, or you less you care about it, the actually more money you might. I always use the same term. The less you care, the more money you'll make. If you rush to get in right away, you will make less money than a person who might be patient and just wait for a better time. Now you will miss some trades. It could open or just take off. First example we looked at, it just took off. And that would have been missed if you're trying to wait for a pullback. But the ones where it pulls back, those are the best trades. Remember, these are all 88, 90% wins. So even if it pulls back, it's still going to hit that target 88, 90 something percent of the time. But now, this, instead of getting a 15 to 20 something percent return getting into the open, and this might be 40 to 50 something percent getting in 5 points lower, we're looking at 80, 90, 100% doubling your money right off the bat at the first target, getting in down here. And if you have more contracts, you can actually trail stops and take part of the position off. Why would you not get out at that big red candle 4 days after you initiated the trade? How are you managing this? There is no stop loss. The stop loss is what you paid for the option. Stop loss is a different type of trading. This is not trading. That's why we're buying calls and puts. You don't need a stop loss. So if you're risking $1,000 a trade, that is your risk. That is your stop loss. So you bought $1,000 worth of options and you're willing to lose $1,000. But that is why we can do this with options so effectively, because we have we know what the entry should be. We know this trade will be profitable. We know we're going to make money. But we know we're going to make a lot more money if we get in at a better price, and a lot more money at an even better price. Okay. So the fact that we can, now, if this was a stock, I'm not as confident buying at the open we'd be profitable here because of volatility crush, implied volatility. Not an issue with the ETFs. That's the big difference. Okay. So 10 different people taking this exact same valid trade will have 10 different results because they're going to be, some will be getting in at the open because they want to get it over with right away. They got to go live their life. That's okay. They will not make as much money as a person who gets in later in the day or later in the week, that type of thing. And there's always going to be that one person, I could get in right down here, but they're going to be so afraid it's going to keep dropping all the way to here. Fair. The trade hasn't changed because it pulls back. It's still going to be the same 88 something percent return or probability of success percentage wins. However, if it's going to be a loss, it's going to be a loss. Big deal, it's going to be a loss. But if it's going to be a win, it's going to be a bigger dollar return. That's how we make the most money. Usually my option trades average about 50% return because almost every single option trade I place is this type of scenario where I get in. Oh, I saw a value, a win, a buy trade valid here, but I don't get in till later on after a pullback. Because if this getting in here is a 20% return, this one win is the equivalent of 2 to 3 regular wins getting in. So one regular win getting in here is maybe a 20% return, but one win getting in here, it could be 80, 90, double your money. So I'd rather take one really good trade, which is better than 2, 3, or 4 regular trades. So that's the way my thinking has evolved over time. That's the way my thinking has evolved. And the more you don't know if it's going to pull back, it could open and take off. We have trades like this one, the same type of thing as what we looked at before. It opened, it pulled back for maybe a couple hours, and then took off. But this one, it pulled back for a couple of days and gave you much better opportunities. So the more patient you are, the more money you're going to make. And I know how Becky does this type of trading. She looks for pullbacks and what's still valid, get in at some other time other than right at the open the next day. But this is how I've evolved. So like I said, most of my option trades average about a 50% return at the first target because I get in at much better price. If it's going to be a loss, it's going to be a loss no matter what. If it's going to be a win. And now I also have, let's say I got in down here. I don't have to get out all the way up here. I can get out after I move to here, lock in profit. And if I want to, get back in a trade because the trade is still in play. Entries up here, as long as you are below the entry price, which is the open here, and the target hasn't been reached yet, the trade's in place. So if I got in down here, I could grab some quick profit here and then get back in, but I'm booking profits. And then I can catch this move up here, trail stops if I want to. So you have a lot of flexibility when we get in on pullbacks at a better price than expected. And that was basically the scenario the last couple of weeks with the market pullback we had. There were buy signals that we had gotten up here with different strategies, but then the market just pulled back hard. But this trade doesn't expire until May or June. So upon getting a pullback, I got into those same long trades down here. The trade was valid up here, but then the market pulled back. Literally, it was valid right around this area right here on a different strategy. And it pulled back, but but I wasn't rushing to get in. I was waiting for, but then all the news was bearish. And looking at the big picture was showing, hey, we're pulling back to that 40. So I just waited. I just waited for that pullback, and I got in, and then I took the long trade, and you get a nice return on it because I have a nice big target. Now you can keep the same original target, which is like a monster return. This is going to be 100. They're going to be double to triple your money. But I got in down here and I got out somewhere up here. But in hindsight, I could have held it for the original target. It would have been still fine, but kind of pushing the limits because expiration was getting kind of close. Okay, I got a question. Hey, Connie. Jessica that was good for March, but she couldn't afford it. Aha. Okay. Let's see. She waited for the pullback, got in April, and there was a bit down, and she got in April, and then very good. Just got a message from someone that caught one of these type trades, and really just capitalized on it, just crushed it. But just by being patient or just paying attention to the emails I send out, because I sent an email showing that big weekly chart and when it was pulling back in real time. It's like, hey, this is pulling back. Wait for the opportunity and jump on it. And someone did. So this is stuff I we look for. This is how we really maximize profits on stuff by getting in it by being patient. All right. So like I said, this is just one other group of strategies. So you got to feel for it. And this happens, setups happen just all the time. Um, I can just stop randomly and oh look, orange line crossed up, buy. Orange line crossed up, buy. Orange line crossed up, buy. Orange line crossed up. Went against you for a couple of weeks and then boom, because we have at least 2 months in the option. And gaps and gaps and gaps is like ridiculously perfect for trade because it just juices up the options. Bullish cross, buy. This is one of Becky's favorite strategies. Bullish crossover, all right across the blue line, buy. And so when this happens, and you got the listing that's in the handout. I'm going back to the handout now. Share. And so, like I said, these are the Donchian crosses that have been valid for this year so far in our listings. If you want to go take a look at those ETFs, if you're setting up the charts on your own, you can use that as a reference to check on these. Um, but that's what's been going on so far. And these are all 84% wins and higher. You have any questions, anything so far? So I can show the seasonal pattern coming up is long in the short term, at least through the middle of June. If you're interested in working with me on any of these strategies, please contact me ASAP before this coming Friday. Um, During meetups, I usually give a discount on the training. And I go through each of the strategies. I will give you the charts for NinjaTrader. I will give you the charts already set up for Thinkorswim. So you don't have to create stuff yourself. So either Thinkorswim or NinjaTrader will give you all the charts so you're ready for the strategies. The trading plans, I meet with everyone one-on-one. I don't do groups, one-on-one only. I figured out one-on-one was better because as I found out along the way, I might have to tell someone the same thing 3 or 4 different ways for them to get it. Um, Not everyone thinks things that I think is simple, other people might not. Things that I think are complicated, people think are simple. So everyone's different how they process information. So I really have to fine tune um, coaching to that person because, like I said, everyone's different. But this stuff works. It's a matter of consistency. I do all training one on one, and I really need people to commit 3 to 6 months of consistent trading. This is what you have to commit to 3 to 6 months to get it. After about 9 months plus, you should be rolling on this on your own. But 3 to 6 months is really needed to experience the ups and downs and all the emotions that go with it because it's not always fun. Eventually, you're going to have 10, 15, 20 trades on at the same time. And they're all going against you somehow all the longs are going against you and all the shorts are going against you. That will happen at some point in time. But guess what? Somehow, some way, eventually 80 something percent of those trades will end up hitting the first targets and you'll be happy again. But it drives you nuts for a while when that's happening in real time. But that's what I'm here for. So always stay in contact with me. If you need to call me and vent, you call and vent. You want to yell at me a little bit, yell at me a little bit, because it's like these strategies aren't working. I'm just losing all my money. I'm like, you don't have any losses. What do you mean? It went all against. Yeah, it's going against you. So going against you is one thing. Losing is something else. Um, but things will go against you. There will be drawdown, but then it all comes back. That's the beauty of options, of just buying calls and puts. We're not going to get stopped out. The only time we use stops, actual hard stops in options, is after the first target. So if you want to take part of your position off after the first target and then trail stops after that to try to maximize profits on remaining contracts, that's when we use stops. The only time we use stop losses is after the first target. The first target is where we guarantee to make money. A lot of people don't want to deal with managing position because they have a life, they have a job, they have family, they don't have time or the personality to manage the stuff each day. So just put a trade on, walk away, put a trade on, walk away. This is not day trading. You just have to enter the position, put in your exit order, and walk away. Your exit order will execute when your target is reached and get you out of the position. That's it. There's nothing else to do. But if you do want to maximize profits and trail stops, that's okay too. Some people do that, and that's fine. Does require more work. Account size can be anything you want, but the bigger your account size, the more choices you have as far as what to trade and when to trade it. Smaller your account sizes, well, it is what it is. You can only trade certain ETFs because the options are not as expensive, but you still get the same type of results as long as you're consistent. All right, so for the option trading, it's 1750 minus the 250 shown up here. If you want to do futures with me, there's a full program if you want to read through that on your own. The futures program, daily chart strategy, 1745, also taking 250 off of that. But if you want to do both the options and the futures, I take 750 off the combined options and futures. The difference in options and futures is futures are very exact. They're not as many trades, but it's very predictable income. And I can literally tell you within a certain range how much I expect to make or lose this year, assuming I don't make a bunch of little mistakes to screw it up. But it's exact. I know how much I'm going to make and how much I'm going to lose. With options, I don't know. I know how much I can lose, but I have no idea how much I can make to the dollar amount because it's not linear. But as long as we get in a better price than expected with options, I can the range of percentage at the first target is usually 15 to 20 something percent return at the first target on most trades, getting in at the open the next day. But getting in a better price than expected, suddenly it goes to 40 to 60 to 80 something percent return at the first target just by getting it at a better price. And that's usually what to expect. That's realistic. And for coaching, I work with everyone one-on-one as long as we need. If you're in the South Bay, I'd rather meet with you in person if at all possible. At least the first time to get charts set up and everything and just see people in person. It's nice to see faces in person, people. And then we can do Zoom after that if you want to. So, but anyway, our next meeting is going to be probably in 2 to 3 weeks, and we'll get back to futures. But I really wanted to focus on options today because the way the markets are moving right now, we have a lot of buy signals in play, both the daily charts and weekly charts. If you're on my email stuff each day, we got even more buy signals from the email I sent out yesterday. So, I got this question here that I missed. How about options do you buy on average on SPY? You buy whatever is appropriate for your account size. Those options cost between $12,000 and $1,500 per contract. So you buy if you can afford it, then you buy it. Otherwise, you have to go with like the little brother of the QQQ is XLK, technology sector. So you can be trading XLK in place of QQQ because it's cheaper. You can be trading XLI in place of DIA because it's about 93% correlated with the DIA, but it's a whole lot cheaper than trading DIA, and that's XLI. So there are choices you can do. What months do you focus on more in options? What this is David asking. Well, you know that for March, June, September, and December, there's very few futures trades. So those months is options, and December is all options because we don't trade any futures in December because of rollover and quadruple witching, and the charts are all messed up. So there aren't as many futures trades in those months. We rather just trade options during those months. And also the October time frame when we look at our buy signals, that's options, baby. That's our time. Whatever you do, you got to be ready for October. When we get our first, whether it starts in September or October, when we get our buy signals, just be ready, have your capital ready. That's the time to go. So that's when I focus more on options than futures, is that end of September, October time frame. That's the best time. Uh, And I'm not sure what your question about quadruple witching months, March, June, September, and December. Yeah. Um, okay. So I'm going to be sending out the video of this meetup sometime later this afternoon. If you're interested in coaching, let me know, and we can set something. You can either call me, email me, message me off the site. I'm pretty findable. Got a question here. Do you also do the put side with Danshin mean? No, we do the downside with different strategies. The Danshin cross is only for the upside. We have different strategies for the short trades. They're all on the like the chart you saw is not a complete chart. It's a filter down chart. Once we have there are two charts we use to trade with. And you only saw the filter down chart for the Danshin cross, that filter down chart just for the meetup, but there's more stuff that goes on the chart, and we trade different strategies for the downside. So we have at least 3, 4 strategies for long, and at least 3 strategies for the short side, at least. But all same type of probability, over 84% wins. Now, oh yeah, let me show you this because I'm not sure I'd shown this during the presentation before we go. Kind of important, I guess. You see this? Uh, these are the trades listing for. This is also available on our website, and if you need it, just email me. I'll send it to you also. But this is the trade listing for this year so far. These are all the trades that were valid that have actually either expired worthless or reached the first target by this past week. Um, uh, about a week ago. Last time Becky updated this for us. But these are all the trades for this year. So it's the ETF, the strategy, like this is the Danshin cross, and what's the win or loss. These are all the sectors and the symbol. And for this year so far, here's the win-loss percentage. And literally look at what the short side's been. So there are people who don't like to trade short, but boy, you miss out when you don't. That's why you have to take your shorts, and you have to take your longs when they come up, because you don't know what the market's going to do. You don't know when the market's going to take a hard nosedive. And when it takes a hard nosedive, boy, these shorts are like, yeah, baby, you're in them. Um, and this money just adds up so quickly because the volatility increases the option prices. So that's why don't shy away from taking short. Some people only want to go long. No, you don't get to tell the market what to do. The market tells you, hey, you got a great short signal here, and um, take the trade, because these can move quickly. Um, but you never know when a top's going to be. So got caught some market tops, and with a lot of shorts here. And we have previous years here too, and the spreadsheets give you the summary of the win-loss on the long side and short side. But that's all readily available. It's part of some of it is on our website, the same link that I put in the chat window. So you can always reference that also. And if there's anything you need, just message me and I can get it to you if it's not readily available on the website. Anyway, but this is what once again, this is what Becky keeps track of. So we need to know what's working, what's not. If something drops below 84%, if 83%, I'm not going to look at it. We keep a line in the sand at 84%, and it works incredibly well for us because there's always margin of error. Not everything's ideal. So margin of error, 84%, and that we're comfortable with. It works extremely, extremely well for us and consistently profitable. All right, so I'm going to switch back to the handout, and unless someone has a question, we're going to bring an end to this meetup, and then we'll reassemble again in 2 to 3 weeks, maybe the first or second weekend in June. I got to figure out when Father's Day is and not do it on Father's Day, basically, but not next weekend as a holiday, but maybe one of the following 2 weekends after that. And we'll have our next meetup. It'll be on futures. And if you have any questions, please email, message me, call me. I'm usually available by phone. Do leave a voicemail. And if you leave a voicemail, leave your callback number, please. Don't just say, call me back at this number. I have no idea what this number is. So if you leave a voicemail, leave your phone number also to call you back, or email me or message me off the website. Unless you have any questions, we're going to go ahead and end it. And if you do have questions, contact me afterwards and I'll answer any questions you have. And if you want interested in coaching, let me know ASAP, so we get you started as quickly as possible because we want you ready for the fall. The fall is when we get some of the biggest trends, so we want you ready, up to speed. Bam, you got all the details worked out before September. Before September is ideal because September, October is when we want you to be all in it and we capitalize on that end of year seasonal pattern. All right, talk to you all soon then. Y'all have a good day.